Buckle up, investors! The 2024 election has concluded, and Donald Trump has emerged victorious. This outcome is bound to have significant implications for the financial markets and your investment portfolios. Trump's victory is set to send ripples through the markets. The immediate reaction might be a surge in market activity as investors react to the news, but the long-term effects will be shaped by his policies and their implementation. Ready to see how it affects your portfolio? Let's dive into the key areas of Trump's economic strategy and what they mean for different sectors and your investments. Trump's economic strategy is all about tax cuts, deregulation, and a tough stance on trade. These policies are designed to stimulate economic growth, but they come with their own set of challenges and opportunities. First up, corporate tax cuts. Trump has consistently advocated for reducing corporate taxes to boost business profits and encourage investment. Lower taxes could boost profits, especially in sectors like finance, energy, and tech. Companies in these industries might see increased earnings, which could translate to higher stock prices and better returns for investors. Sounds good, right? But there's a catch. While lower taxes can boost short-term profits, they can also lead to increased national debt if not balanced with spending cuts. Next, let's talk national debt. The U.S. already has a significant debt burden, and further tax cuts without corresponding spending reductions could exacerbate this issue. Cutting taxes without slashing spending? This approach might lead to more borrowing, increasing the national debt, and potentially leading to higher interest rates in the future. That might mean more borrowing and a bigger debt. Investors need to be aware of the long-term implications of rising national debt, including the potential for inflation and higher interest rates. Short-term gains, but long-term pains. While the market might react positively in the short term, the long-term effects of increased debt and potential inflation could pose challenges. Then, there's the Federal Reserve. Trump has expressed a desire for more control over monetary policy, which could lead to changes in how the Fed operates. Trump wants more control over monetary policy. This could mean pressure on the Fed to keep interest rates low, which might boost the markets in the short term, but could also raise concerns about the Fed's independence. Lower interest rates could pump up the markets, but could spark concerns about the Fed's independence. Investors should be cautious about the potential for market volatility if the Fed's policies are perceived as politically influenced. And don't forget trade tariffs. Trump's tough stance on trade could lead to increased tariffs on imports, which might protect U.S. industries, but also disrupt global trade. Tariffs aimed at protecting U.S. manufacturing might hit global trade. This could lead to higher costs for imported goods and potential retaliatory tariffs from other countries. Watch out, tech and consumer goods sectors. These industries rely heavily on global supply chains, and increased tariffs could lead to higher costs and reduced profitability. Historically, the S&P 500 reacts based on broader economic context. While initial reactions to political events can be significant, long-term trends are influenced by a variety of factors. Initial market gains post-election? Sure. Investors might see a short-term boost as the market reacts to the election results, but it's important to stay focused on the bigger picture. But long-term trends depend on factors like inflation, employment, and global trade relations. Sectors to watch? Keep an eye on industries that are directly impacted by Trump's policies. Oil and gas, defense, and finance could see benefits. These sectors might experience growth due to favorable policies and increased government spending. Tech, consumer goods, and healthcare might feel the pinch. These industries could face challenges due to increased tariffs, regulatory changes, and shifts in government spending priorities. So, what's the strategy? Don't try to time the market. Instead, focus on building a diversified portfolio that can weather different economic conditions. Focus on fundamentals and long-term growth. Look for companies with strong balance sheets, competitive advantages, and the ability to adapt to changing market conditions. Diversify your investments, keep an eye on global trends, and stay informed. Got it? Awesome! Staying informed about global economic trends and how they might impact your investments is crucial. Now, let's navigate these market waves together. By staying informed and making strategic investment decisions, you can position yourself to take advantage of opportunities and mitigate risks in the ever-changing market landscape.